So we've seen how to build income statement, balance sheet, and statement of cash flows off of a set of assumptions. Now we want to think about how to take those values and project them forward over many periods. Because oftentimes you want more than just one period of forecast for your financial statements. That way we can build, DCF valuations, we can build cash flow run rates, and really understand our business a little bit better out into the future. All right, and there are a number of ways that we can actually do this. You'll see here that I've actually already set up a set of projections that range from time 0 through time 5. So we're going to do a 5-year model here. We're basically taking our same model that we just worked with. We're just taking that as year 1, and we're going to add years 2, 3, 4, and 5 on out to it. So I've made a couple adjustments that I want to talk through in our assumptions. The first is that you now see that we have sales assumptions through all 5 years. We're going to have increasing sales in our candy company. I arbitrarily picked what those are. Now, one way to model out sales is to do individual periods such as this, right? You could also opt for a growth rate, right? You could say sales are going to grow 10% per year. Now, you could either do that in the model like this, right? Take the previous period times something like 1.1, and you could paste that formula all the way to the end. That's one option, right? One thing I don't love about that is you've hard-coded the 10% growth, right? If you're going to do that, make that a parameter. Right? That's going to be one way. You could also model with different growth rates each period. That'd be a little bit more dynamic. And ultimately, it's going to be a question for each line item in your financials. Do I want this to be a changing parameter, right? Do I think it's going to change over time? Or should it be more static, as this is going to be the same year after year after year? And so your choice really depends on understanding the business and really the underlying economics behind it. So there's never going to necessarily be a surefire right answer for one situation or another. It's always going to be business context dependent. So in this case, I'm going to build my sales out in units. I'm going to leave my prices per unit constant, right? Both for prices and costs. You could argue that these are going to increase over time from inflation. I'm not going to build inflation into this model. If you wanted to, you could definitely add that complexity in, but I don't think we need to quite yet. Inventory purchases were something we had in our previous model. This is how much we're buying ahead of time or over the course of the year. This is one way to model inventory. We're going to build it out this way to start, and I'm going to flip it and show you guys another way to model inventory towards later in the video. We also have our credit card use, both for purchases and sales. These seem reasonable to leave constant. Let's say 50% and 20% are going to be stable over time, right? Here, I don't have a good business reason to think those are going to change, so it's okay to use a static input. Our cart cost, right? We bought our candy cart for $2,000 at time 0. Well, we think this business is going to grow, so let's go ahead and put a couple more periods where we buy more candy carts. That, I think, is going to change over time. The useful life of candy carts is probably not going to change, though. Unless there's some big candy cart innovation that comes along, we still think they're going to last about 5 years. So let's leave that as a constant parameter. Loan amount, this is how much we're going to raise in debt each period. This is certainly a dynamic concept, right? We might raise more debt later on. There are occasions when you're only going to raise debt once, or you're going to only do an equity raise once. In that case, it can be a static input. And for this model, I'm going to build it dynamically. Our interest rate, though, we'll leave that constant. I know that interest rates change over time, but for simplicity, let's leave that constant. And our tax rate, we're going to model at 25%. Again, a constant tax rate. Taxes do change. If you have a view on that, then you can build that into your model. And finally, our crowdfunding equity raise, we did $10,000 at time 1. The CEO told me that he doesn't want to raise any more equity. He just wants to do debt, so we're going to leave that as a static input.